One of the biggest deal killers when you're buying a small business is your negotiation around net working capital. In this video, I'm going to explain to you what net working capital is, how to calculate it, and what pitfalls you need to look out for along the way. First, let's talk about what is net working capital. Net working capital is the measure of how much cash you need tied up in your business in order to fund operations. One way to visualize net working capital is to think about it like a timeline. If you took a really simple business, and in that business on day 0 you purchase some inventory, and you have terms with your vendors, and then you pay for that inventory on day 30, and then you're able to sell that inventory on day 60, and then your customer has terms with you and will eventually pay for that inventory on day 90. You've now sent money out the door on day 30, and that money hasn't come back until day 90. So you have a 60-day period where you need to be able to fund all of your expenses, and that is ultimately the working capital that you need to keep operations running. An important distinction when you're buying a small business with working capital is that it's not just to measure how much cash you need in your bank account when you close in the transaction. If you took a professional services company, for example, that has really low accounts receivable because they get paid up front on all the work they do, and they have no inventory, they're gonna have a very low working capital requirement in that company. However, they're still gonna have some cash in the bank in order to take advantage of opportunities that come up, be able to sleep at night, and also just deal with seasonality and potential downturns in their business. So you wanna both have the amount of working capital that you need in the company and also some cash reserves to be ready for anything that can happen in that particular business. So why is working capital always such an issue in these small business transactions? One of the reasons is that buyers and sellers often just don't totally understand working capital and how it should be properly calculated and how it works. And also, it has a direct impact on purchase price. If insufficient working capital is included in the deal, then as a buyer, you're essentially paying more for the business. And on the sell side, they often look at the accounts receivable that you're purchasing as work that they've already done and really should be money in their pocket, and you as the buyer are trying to negotiate to purchase that. And sometimes it just won't sit well if the seller is not used to this type of transaction. Another reason that working capital can sometimes be a big issue is that on small business transactions, the books aren't always perfect. So calculating working capital can take some work to make the proper adjustments, or maybe sometimes the data is just not there at all and you have to do your best estimate to figure out what the actual working capital is for this particular company. One of the ways to avoid net working capital issues in your deal is to agree on as much as you possibly can as early as possible. A great way to do that is to have a diligence provider start calculating the working capital right after you get under LOI, and they can even help you pre-LOI with making an estimate for your deal. If you want a free calculator that can help estimate working capital pre-LOI, click the link down below and I have a free one that you can download. So let's talk about, in a small business transaction, how you actually calculate working capital. To start, you'll take the seller's financials and you'll list out all of the current assets and all of the current liabilities that are on their balance sheet, and you'll look at them on a month-to-month basis for at least a 12-month period. You'll then have 3 main types of adjustments to those figures that have been provided to you by the seller. First, you're gonna have definitional adjustments. So by definition, you're buying these businesses cash-free and debt-free, so you're gonna remove from the calculation of working capital all cash and all debt and any debt-like items that are included in the current assets and current liabilities. The second type of adjustments that get made are due diligence adjustments. Due diligence adjustments are gonna be ones that are generally made by your due diligence provider, your quality of earnings provider, and they're gonna go through the seller's financials and they're gonna look for any potential errors that have been being made. Sometimes you're gonna see things that are one-time events that are sitting out there. You might see some really old transactions that need to be adjusted out, or maybe they're just not issuing invoices at the right time and there should be an adjustment to bring the financials to a real accrual number instead of the cash or maybe pseudo accrual figures that were being used by the sellers, and very common in small businesses. The third type of adjustment you're gonna see made are pro forma adjustments. These are less common, but they do occur, and they're generally gonna be adjustments that are made when there's been a recent change in the business and you wanna see that recent change over a longer period of time to show what the business would look like over the full historical period with those adjustments in place. An easy example of this would be the business that you're buying has recently had a major change with their terms with a major vendor. So previously they had terms with that vendor where they had to pay in 15 days and they've always paid in 15 days. However, maybe last quarter, they change to now they get to pay that vendor in 30 days. So you want to see that change and how that would have affected the business over the entire 12-month period that you're looking at. So now that you have your recast view of working capital on a month-to-month basis, you want to set your net working capital peg for your business. Now there's different ways you're going to handle this depending on if it's a steady state business, if this business is growing or shrinking, or if it's a seasonal company. If it's just a steady state business, the most common example you're going to see used for setting the working capital peg is going to be a 12-month average of the normal level of working capital. However, if the business is growing quickly or it has been shrinking, it might make more sense to use a 3-month average or maybe a 6-month average, because that more recent history is more representative of where the business actually is at today. Finally, occasionally you're going to deal with some businesses that are very seasonal in nature. Think about a company that puts up Christmas lights or sells Halloween costumes where they're really only active and making sales in a small portion of the year. They might be completely inactive or have very low activity in the rest of the year. In those cases, what you'll generally do is you'll take your 12-month average and then more heavily weight the months where the business is heavy into operations and discount the months where the business isn't as active. That way your working capital peg more accurately represents the seasonality of the business that you're buying. So how does working capital actually work in a small business transaction? A lot of it's going to depend on the size of the business that you're buying. So in larger transactions, what is very common to see is that there'll be a net working capital true up. So you'll have your working capital peg. Let's say in this example, your peg is $1 million. And so the seller is expected to provide to you $1 million of working capital on the day of closing. Then on the day of closing, you'll calculate how much working capital is actually being delivered and you'll true it up. So maybe there's only 800 grand that's being delivered. The seller will have to either provide you another 200 grand of cash to make you whole or reduce purchase price. However, because working capital is a living, breathing mechanism in a small business, it's very difficult to know on any given point in time exactly how much working capital is being delivered. So that 800 grand that you calculated is probably an estimate. What will then actually happen is 90 days later, you'll recalculate the amount of working capital that's delivered at closing and you'll do a true up. So maybe you calculated that it was 800 grand on the day of closing. It actually was $823,000. So there'll be a $23,000 true up 90 days after the transaction closed. Now in a little bit smaller transactions, maybe mid-size 1 to 5, maybe $10 million transactions, usually working capital is handled a little bit more simply. There's usually not a 90-day true up, and you're gonna do a little bit simpler calculation of working capital on the day of closing, where maybe you're just gonna include accounts receivable, inventory, and maybe some of the payables, rather than going deep and calculating every piece of the balance sheet. So if you're supposed to get $600,000 of working capital at close, because that was the peg that you agreed upon, the seller might count out for you $300,000 of inventory, $300,000 of accounts receivable, and that will be the working capital that you get at close, and there won't be a true up after closing. Finally, in smaller transactions, maybe sub $1 million, and then sometimes in deals a little bit larger than that, you won't see any working capital delivered. Instead, the buyer will just account for no working capital being delivered into their purchase price calculation, and then they'll just borrow what they need from the bank, either with permanent working capital from the bank or getting a line of credit. As you can see, there's a lot of moving pieces when it comes to calculating working capital in a small business acquisition. If you'd like an expert in your corner for your small business acquisition, reach out to us at Midwest CPA and we'd love to help. We help acquisition entrepreneurs avoid buying the wrong company and then successfully grow the right.